Hi, my name is Jason Gunkel, and I lead our investment team here at Severson Straight. Thanks for joining us for the fourth quarter market update. Well, I can't believe that the fourth quarter and the year is almost over. It has been quite the year. And as you can see here on this chart, we see that it has been a roller coaster ride. Starting with the news from the pandemic that occurred in late February, the market dropped about 34%. After that time, and investors were more optimistic about the economy reopening, we saw the market recover and rally about 60% to September. And then in the couple months leading up to the election, investors were a little more nervous and the markets went sideways until after the election, and also with news of the vaccines coming out, the market rally resumed, and the market is up 13% through November and into December as we record this today on December 15th. With the roller coaster ride that we've experienced in the market, it caused a lot of investors to panic. And this chart here shows that almost 18% of all investors and about 30% of investors over the age of 65 sold all of their stock sometime between February and May of this year, which was a very surprising statistic for us to see. And also, it was too bad because I'm sure many of those investors did not take part in the market recovery. As we've been saying throughout the year, much of the market recovery has been led by technology stocks, and the big five technology stocks in particular, with Facebook, Amazon, Apple, Microsoft, and Google, which are up over 51% on average this year. And the rest of the 495 stocks that make up the S&P 500 index are up about 9% this year. So as we record this today, through December 15th, the S&P 500 is up about 19% on the year. And there's been a big discrepancy, a big dispersion, I should say, of where those returns have come from. And the growth side of the market, which includes technology stocks, is up close to 40%, whereas the value side of the market, which includes some sectors such as energy and financials, are down almost 5% still on the year. However, what we've seen in the last 3 months is a rotation where the value stocks have actually been outperforming the growth stocks. And we expected this to occur when investors were more confident of more of a widespread economic recovery. And that, as you see with this chart here, with a chart that's produced by Fidelity, you can see that the US economy and many other economies across the globe are in the recovery phase, and they have left the contraction phase and are officially in the recovery phase of the economic cycle. And so there's been much talk about what shape the economic recovery would take, and where the stock market has had a V-shaped recovery. The economy so far, if you look at this chart, it also looks like a V-shaped recovery. And since the GDP numbers fell and recovered significantly in the third quarter, we're about 2/3 of the way to where we were before the pandemic hit. This looks like a V. But the expectations are the economic recovery will slow a little bit, and we hopefully will be at prior levels prior to the pandemic by the end of 2021. And as we see, the economy has recovered significantly because unemployment has been dropping as well, and many companies are hiring back the employees that were temporarily laid off. And so unemployment has fallen from a peak of close to 15% all the way down to under 7%. But unemployment could continue to be a drag on parts of the economy. We see certain industries such as oil and gas, leisure and hospitality, and transportation that have elevated unemployment that could continue for some time. After the election, the market reacted positively as investors seemed to focus mostly on the result that Congress will likely be divided. There's still a runoff to occur in Georgia, but it looks like the odds are still that Congress will be divided. And this chart shows over history, a Democratic president with a divided Congress has actually produced the highest returns. And the stock market has averaged an annual return of close to 11% over the 4-year presidential cycle under that scenario. Some investors have voiced their concern to us that with a Democratic president, the likelihood of tax increases is higher, and that those tax increases could affect the stock market. And this chart shows that since 1950, there have been 13 times in history that taxes have increased. And maybe surprisingly, in those 13 years, the stock market has averaged an annual return of over 12%, which is above average. And so even though higher taxes could be a headwind to the markets, there's many other factors that affect the stock market. And so what we've seen in the past is that those factors have caused the stock market to rise even as taxes have increased. And then finally, as we look at our crystal ball, looking into the future, this chart is provided by one of our partners' research affiliates, and it looks forward over 5 to 10 year periods. And you can see that international, represented by the EFI index, and emerging market stocks are projected to have higher returns than in the US overall. But you can also see in the middle here that US value stocks are still projected to have high returns. And that's the part of the market, as we saw earlier, that has still not recovered as much as the growth side of the market has. And so don't be surprised if the investment team here decides to increase our allocation to some US value stocks as we head into 2021. Well, it's been quite the year, and it has actually turned out to be quite a good year in the stock market. We can be thankful for that. As we head into 2021, we are optimistic about the markets, at least certain parts of the market, as we see that we may have gotten past the worst of the pandemic. And with the vaccine news, it could lead us through a tough winter and be enough to keep the market rally going in 2021. And so thank you for your continued trust in us this year. We hope you enjoyed the holidays. Happy New Year. We hope to see you next year in person instead of over Zoom. Take care.